Picture this. You sit down to check your household finances for the month, and you discover that not only have you covered all your bills, your mortgage, your food, your energy, but you've actually got £30 billion left over. Obviously, that's not something any household is going to experience. But in January 2026, that's essentially what happened to the UK government. According to the Office for National Statistics, the UK public sector recorded a surplus of £30.4 billion in a single month. That is the largest monthly surplus ever recorded in British public finances since records began back in 1993. It's nearly double the figure from January 2025, and it beat every single forecast made by economists in a Reuters poll, as well as the government's own official forecaster. So what actually happened? Is this a turning point for the UK economy? And what does it mean for you, as a taxpayer, as someone paying a mortgage, or as a business owner? In this video, we're going to walk through the real numbers, explain what drove them, and give you the honest, balanced picture. No hype, no spin, just the data. Before we get into the details of January's figures, let's make sure we're all on the same page about what a fiscal surplus actually means, because this is one of those terms that gets thrown around in financial headlines but isn't always clearly explained. The UK government, like any organization, has money coming in and money going out. Money comes in mainly through taxation, income tax, corporation tax, VAT, national insurance contributions, capital gains tax, and more. Money goes out on public services, the NHS, schools, welfare payments, defense, infrastructure, and crucially, servicing the interest on the national debt. When spending exceeds income, the government runs a deficit, and it has to borrow money to fill the gap. This borrowing adds to what's called the national debt. When income exceeds spending, the government runs a surplus, meaning it collects more than it spends in that period. Think of it like a personal bank account. If you earn £3,000 this month and spend £2,500, you have a £500 surplus. But if you're already carrying a credit card balance from previous months, that surplus doesn't eliminate the overall debt. It just means you added a little less to it or paid a little of it back. That's an important distinction, and we'll come back to it when we talk about the UK's national debt, which still stands at nearly £2.9 trillion. Most months, the UK government runs a deficit. But January is different. It's when self-assessment tax returns are due, the deadline for millions of self-employed workers, investors, and higher earners to pay their annual income tax bills. This floods the Treasury with cash and almost always produces a monthly surplus. The question each year is, how big? This January, the answer was historically big. Let's look at exactly what the numbers say, sourced directly from the Office for National Statistics Bulletin, published on the 20th of February 2026. The UK public sector recorded a £30.4 billion surplus in January 2026. To put that number in context, a year earlier, in January 2025, the surplus was £14.5 billion, and 2 years ago, in January 2024, it was £14.3 billion. So this year's figure is more than double the recent trend. The OBR, the Office for Budget Responsibility, which is the UK government's independent economic forecaster, had expected a surplus of around £24.1 billion in January. The actual figure came in £6.3 billion above that forecast, and according to Reuters, it topped every estimate in a poll of city economists. The consensus had been around £23.8 billion. That kind of outperformance doesn't happen by accident. So what were the engines behind it? The single biggest surprise was capital gains tax, or CGT. According to the ONS and analysis by wealth management firm Evelyn Partners, cited in BBC News, capital gains tax receipts in January 2026 came in at nearly £17 billion. That is roughly 69% higher than January 2025, when CGT brought in around £10 billion. Now, why such a dramatic jump? Analysts believe it largely reflects the behavior of investors who chose to sell assets ahead of the CGT rate increases announced in the October 2024 budget. Essentially, many people disposed of stocks, property, and other assets in the 2024-25 tax year before the higher rates took effect, and those tax payments flowed into January 2026's self-assessment returns. This is an important nuance. This CGT windfall may not repeat at the same scale next year because the underlying behavioral trigger, anticipating a tax change, was a one-time event. It's a genuine revenue figure, but one that analysts and the IFS have flagged may be a timing effect rather than a permanent structural shift in the tax base. The second major driver was income tax and national insurance contributions. Self-assessed income tax receipts for January 2026 reached £29.4 billion. That's £3.6 billion more than in January 2025 and £1.7 billion above the OBR's own forecast for the month. The OBR had expected around £27.7 billion. Why the overshoot? A big part of the story is something called fiscal drag, a phenomenon where even though tax rates don't change, more people end up paying higher rates because their wages have grown with inflation, while tax thresholds have remained frozen. In the UK, income tax thresholds have been frozen since 2022, and as wages have risen, partly due to inflation, more workers have been pushed into the higher 40% tax bracket, or over the basic rate threshold for the first time. According to Paul Dales, chief UK economist at Capital Economics, this threshold freeze has been quietly and consistently pulling more revenue into the Treasury each year. On top of that, employer national insurance contributions increased by £2.9 billion in January compared to a year ago, following rate changes that came into effect in April 2025. Across the financial year to January, total compulsory social contributions have risen by £26.1 billion, or nearly 19%. In total, central government tax receipts were £133.3 billion in January 2026, up 13.8% from £117.1 billion in January 2025. The third factor is perhaps the most quietly significant. The government spent dramatically less on servicing its debt in January 2026 than it did a year earlier. Central government debt interest payable came in at just £1.5 billion in January 2026, compared to around £6.5 billion in January 2025. That's roughly £5 billion less. Why? A large chunk of the UK's debt is linked to the retail prices index measure of inflation. As RPI has eased compared to its peak, the interest costs on those index-linked gilts have fallen with it. The ONS's chief economist Grant Fitzner noted this directly, saying that lower debt interest payments largely offset higher costs on public services and benefits. This is a genuine saving, but one that is tied to inflation staying lower. If inflation were to rise again, this relief could quickly reverse. Zooming out from January's single-month figure, the broader financial year tells a similarly encouraging, if still sobering, story. According to the ONS, from April 2025 to January 2026, the UK public sector borrowed a cumulative total of £112.1 billion, that is, 11.5% less than the same 10-month period a year earlier when borrowing stood at £126.7 billion, £8.3 billion below the OBR's forecast of £120.4 billion. The Institute for Fiscal Studies called this borrowing falling faster than expected, but crucially added that £112 billion over 10 months still represents the fifth highest April to January borrowing on record. Progress is being made, but the baseline remains high. What it means for UK taxpayers. Let's start with the question most people will want answered first. Does this surplus mean anything for me? The honest answer is partly yes, partly not yet. The improvement in public finances has been partly achieved through higher tax revenues, and much of that has come from people and businesses paying more. Income tax receipts rose across the financial year because of the threshold freeze. National insurance went up. Capital gains tax rose. These are real costs that real people and businesses have borne. For those hoping this surplus signals imminent tax cuts or a loosening of public spending, economists urge caution. The government is still borrowing over £100 billion a year overall. Its explicit fiscal rule is that it wants day-to-day spending to be fully funded by tax revenues, and it is not yet there. That target is set for 2029 to 30. So for the moment, the surplus reinforces a period of fiscal consolidation, meaning the government is working to bring borrowing down, not necessarily to put more money back into people's pockets in the short term. Where taxpayers may start to feel an indirect benefit is through the possibility of lower interest rates, which affects mortgages, loans, and business borrowing costs, which we'll discuss in a moment. For the government itself, this surplus is a meaningful piece of good news heading into the spring statement on March 3, 2026, when Chancellor Rachel Reeves is due to present updated economic forecasts from the Office for Budget Responsibility. The OBR currently forecasts a full-year deficit of £138.3 billion, or around 4.5% of GDP, for the 2025-26 financial year. With year-to-date borrowing running at £112.1 billion and the year already 10 months in, economists at Capital Economics and the IFS suggest the final deficit could undershoot the full-year OBR forecast by around £10 billion. Chief Secretary to the Treasury, James Murray, said the government was on track for 2026, borrowing to be the lowest since before the pandemic, and pledged to more than halve borrowing by 2030-31. However, economists at KPMG UK noted that the Chancellor's fiscal headroom, the margin she has against her own rules, has likely shrunk by around £3 billion since the November 2025 budget. Senior economist Denis Tatarkov attributed this to weaker than expected economic growth in the second half of 2025, which has shaved off an estimated £6 billion from the nearly £22 billion of buffer created at the budget, partially compensated by lower interest rates. In other words, the surplus is welcome, but the government is still walking a fine line on its fiscal rules. Now let's turn to something that touches millions of UK households directly: interest rates. UK inflation fell to 3.0% in January 2026, according to the ONS Consumer Price Index Bulletin, the lowest level since March 2025. This is still above the Bank of England's 2% target, but the direction of travel is encouraging. The Bank of England held its key interest rate, known as bank rate, at 3.75% at its February 2026 meeting. That followed 6 consecutive rate cuts since August 2024, which had brought the rate down from a peak of 5.25%. At its February meeting, the bank said it now expects inflation to return to the 2% target by spring 2026, and that there should be scope for some further cuts to bank rate this year, though it was careful to say each decision would depend on incoming data. If inflation continues to fall and interest rates are cut further, that would have real and meaningful effects on UK households. Mortgage costs could ease for those on tracker or variable rate deals, and the cost of consumer borrowing could decline. However, a note of caution. The National Institute of Economic and Social Research has warned that inflation may remain above 3% for much of 2026, partly due to energy prices and domestic cost pressures. That potential stickiness introduces genuine uncertainty about the pace and scale of any future rate cuts. The bank itself has emphasized it will take a gradual and careful approach. For businesses and investors, the picture is one of cautious optimism alongside real structural challenges. On the positive side, the improvement in UK public finances helps support stability in the gilt market, that is, the market for UK government bonds. Lower and falling borrowing tends to be welcomed by bond investors as it reduces the risk of the government having to borrow at higher rates. Credit rating agency Fitch affirmed the UK's sovereign credit rating at AAA with a stable outlook in February 2026, citing the improving fiscal trajectory. Lower inflation and the prospect of further bank rate cuts could also improve the investment climate for businesses, reducing the cost of debt financing and potentially supporting consumer spending. On the other hand, the broader economic backdrop presents real headwinds. Fitch projects UK GDP growth will slow to 1.1% in 2026, down from 1.3% in 2025. UK unemployment rose to a 5-year high of 5.2% in Q4 2025. And GDP grew by just 0.1% in Q4 2025, the same underwhelming rate as Q3. Paul Dales of Capital Economics observed that while January's data was a healthy start to the year, recent retail growth had been boosted by transient factors, like a New Year spike in health and fitness spending, which would fall back as people fell off the New Year health kick. He cautioned that underlying economic momentum remained modest, and that growth was unlikely to be much more than 1% in 2026. Let's step back and look at this clearly from both sides, because this is exactly where responsible reporting matters. There is genuine good news in this data, and it deserves to be acknowledged clearly. The £30.4 billion January surplus is a real verified record, backed by primary ONS data and confirmed by multiple independent sources. It demonstrates that tax revenues are growing, supported by a combination of employment levels, wage growth, and structural changes like employer NI increases. Year-to-date borrowing is running below the OBR's forecast, which is a positive signal for fiscal discipline. Debt interest costs have fallen, providing genuine near-term relief to the public finances. The Chancellor enters the spring statement with a stronger foundation than many expected just months ago. Inflation is falling, and the Bank of England has signaled that rate cuts remain on the table. These are meaningful developments. Not spin, not noise, but genuine data-backed improvements. But there are equally important things this surplus does not tell us, and any responsible analysis has to include them. First, January is structurally different from other months. The government almost always runs a surplus in January due to self-assessment tax flows. The extraordinary size of this one is notable, but it does not mean the rest of the year will follow suit. February through March typically see borrowing resume. Second, the capital gains tax surge may not repeat. As analysts at Evelyn Partners and the IFS have noted, much of the CGT windfall was driven by investors front-running the October 2024 rate changes, a one-time behavioral effect. The IFS warned explicitly these figures will be revised and revised again, and so we should not place too much weight on figures from any single month. Third, the national debt remains historically elevated. The UK's public sector net debt stands at approximately £2.9 trillion, 92.9% of GDP at the end of January 2026. The ONS notes this is at levels last seen in the early 1960s. A single strong month does not meaningfully change this structural reality. Fourth, the full-year deficit remains very large. The OBR forecasts a full-year deficit of around £138.3 billion for 2025-26. Even undershooting this by £10 billion still leaves annual borrowing at a historically elevated level. The Institute of Chartered Accountants in England and Wales stated clearly that the budget overrun remains significant, re-emphasizing the weak economic position that is driving the government's need to borrow. Fifth, underlying economic growth is weak. With GDP growth of just 0.1% in Q4, unemployment at a 5-year high of 5.2%, and business investment falling, the economic foundations for sustainable improvement in public finances are not yet fully secure. As IFS researcher Nick Ridpath put it, the plan for a current budget surplus by 2028 to 29 is reliant on marked reductions in borrowing over the next few years. And those reductions depend heavily on continued strong tax receipts and economic growth, neither of which is guaranteed. Sixth, debt interest remains sensitive to inflation. The welcome fall in debt interest costs is tied to lower RPI inflation. Should inflation remain sticky or rebound, a risk the NESR and others have highlighted, this relief could prove temporary. The bottom line, direction of travel is improving. The structural challenge is not yet resolved. Both things are true at the same time, and it's important to hold both of them. So where do we go from here? There are several key events and data points on the horizon that will shape how this story develops. March 3rd, 2026, the spring statement. Chancellor Rachel Reeves is due to present the government's fiscal update, accompanied by new forecasts from the Office for Budget Responsibility. This will be the first major set of revised projections since the November 2025 budget. According to analysis by The Guardian and The Times, economists expect the OBR to update its view on growth, borrowing, and the fiscal headroom available to the Chancellor. Bank of England, March 19th meeting. The Bank of England's next scheduled Monetary Policy Committee meeting is on the 19th of March 2026. Given that inflation has fallen to 3.0% and the bank has indicated room for further cuts, financial markets and analysts will be watching closely for any change in bank rate. Ongoing borrowing data. The ONS will publish monthly public sector finance data through to the end of the financial year in March. These will show whether January's strong performance translates into sustained improvement or whether it partly reflected timing effects that don't persist. Economic growth trajectory. If the UK economy can sustain and accelerate growth from its current sluggish base, with GDP growth currently tracking around 1%, this would support stronger tax revenues and a more manageable debt path. If growth disappoints further, the fiscal arithmetic becomes more difficult. None of this is certain. These are factors to watch, based on what credible sources and economists have identified, not predictions of what will happen. Let's bring this all together. January 2026 delivered the UK's largest monthly fiscal surplus on record, £30.4 billion, verified by the Office for National Statistics and reported by the BBC, Reuters, The Guardian, and the Wall Street Journal. It was driven by a surge in capital gains tax, higher income tax and national insurance receipts, and a significant fall in debt interest costs. It beat the OBR's forecast by over £6 billion, and it pushed the year-to-date borrowing figure nearly £9 billion below official expectations. This is good news, full stop, but it is also one data point in a complex, ongoing story set against a national debt of £2.9 trillion, GDP growth of just 0.1% in Q4 2025, unemployment at a 5-year high, and inflation that is still above the Bank of England's 2% target. The UK government's fiscal position is improving, not yet improved. Progress is real. The full challenge is also real. What happens at the spring statement on March 3rd and how the OBR revises its forecasts in light of this data will be one of the more important economic moments of the year. We'll be covering it in detail, so if you want to stay informed with data-driven, straightforward analysis, make sure you subscribe. And before you go, what are your thoughts on this surplus? Do you think it genuinely signals a stronger direction for the UK economy? Or do you think the national debt and sluggish growth tell a more complicated story? Leave your view in the comments below. I read every single one. Thanks for watching. Stay curious, stay informed.